It's September 2008. People are going to work. Kids are going to school. Stores are opening like any other Tuesday. But behind the scenes, the world's financial system is hours away from breaking. Banks no longer trust each other. Trillions of dollars are at risk. And it all started with something as ordinary as buying a house. So, how did the global economy get here? Let's rewind a few years. America is in the middle of a housing boom. Homes are selling faster than ever. Prices keep climbing. Families rush to buy before prices rise again. Investors pour money into real estate because everyone believes the same thing. House prices only go up. Banks love it. Every new mortgage earns them money. But instead of waiting 30 years to be repaid, they bundle thousands of mortgages together into giant investment packages and sell them to investors around the world. Imagine a giant box filled with thousands of IOUs. As long as homeowners keep paying, everyone makes money. It's so profitable that Wall Street wants more and more. Soon banks stop asking a different question. Can this person actually repay the loan? Instead, they ask, can we sell this mortgage before anyone notices? Loans are handed out to people with unstable incomes, tiny down payments, and sometimes barely any proof they can afford the house. It doesn't seem to matter. Prices keep rising, so everyone assumes the risk will disappear. It feels like a machine that prints money, until one day, it doesn't. House prices stop climbing. At first, nobody panics. Then homeowners with risky mortgages begin missing payments. The giant boxes of mortgages that investors thought were safe suddenly aren't worth what everyone believed. And that's when fear takes over. Banks don't know who owns the bad investments. Investors don't know which banks are in trouble. Lending slows. Then it almost stops. Imagine trying to lend your friend money when you suspect their wallet might actually be empty. You wouldn't. Neither did the banks. On September 15, 2008, Lehman Brothers, one of America's biggest investment banks, collapsed. Overnight, confidence disappeared. Stock markets plunged. Businesses struggled to borrow money. Companies laid off workers. Families lost homes, jobs, and retirement savings. The crisis spread across the world because modern finance had connected everything together. A problem that began in one corner of the U.S. housing market suddenly reached Europe, Asia, and far beyond. Governments and central banks stepped in with emergency loans, bank rescues, and record-low interest rates. The goal wasn't to save reckless banks. It was to stop the entire financial system from freezing. Economist Hyman Minsky had warned for decades that long periods of stability often encourage people to take bigger and bigger risks until the system becomes fragile. In 2008, his warning became reality. The biggest lesson wasn't that houses can lose value. Everyone already knew that. The real lesson was that money itself depends on trust. Banks trust borrowers. Investors trust banks. Businesses trust the financial system. And when that trust disappears, even for a few days, the economy can grind to a halt. So the next time you hear about interest rates, housing prices, or another bank making headlines, remember this. The 2008 financial crisis wasn't caused by houses. It was caused by millions of people believing the system could never fail, until it did.